Hello folks, this is Howard Reisel from Invest Financial Corporation with the September Quarterly 3 video. Thank you for joining us today. For today's presentation, we will be focusing on major events in the third quarter and looking ahead at some of the challenges facing markets in the fourth quarter. So let's do the third quarter wrap-up. Volatility was really the name of the game during the third quarter this year as markets were pummeled by Fed fears, a conflict in Syria, and budgetary debates in Washington. Despite all the volatility, markets still turned out a solid performance. We saw two major indices, the Dow Jones Industrial Average and the S&P 500, reach new highs in mid-September. For the quarter, the S&P 500 gained 4%, the Dow gained 1%, and the Nasdaq gained 9.25%. On the economic side of things, we had a reasonable, decent quarter. Major indicators show that the economy is still growing, but at a modest pace. Estimates of third quarter GDP growth were revised downward slightly, though we're still expecting to see Q3 growth above 2%. On the other hand, second quarter GDP growth was revised upward to 2.5% due to an unexpected increase in exports. Despite some worries about the rising mortgage rates, the housing sector is still doing well. Home prices are up across the nation and home sales are growing. The labor market continues to improve. While overall unemployment has dropped to 7.3%, hiring remains below healthy levels and people are still dropping out of the job hunt, meaning there's still a ways to go. On the negative side, consumer sentiment dropped in September to a 5-month low due to consumer worries about high interest rates and the drama in Washington. The Federal Reserve was on everyone's mind this past quarter, and concerns about an end to quantitative easing contributed to a lot of the market volatility investors experienced. Coming out of the Great Recession, the Fed instituted several bond buying programs which have resulted in $3.5 trillion in total bond purchases. These purchases continue to grow to the tune of $85 billion each month. Now that the economy is doing better, the Fed wants to start cutting back on its monetary support and start unloading all of those bonds. Though Wall Street was convinced that tapering would begin after September FOMC meeting, the Fed took a look at economic data and decided to delay action until they feel more confident about the economy. While we believe that the economy is strong enough to withstand a gradual shift away from Fed programs, we're happy that the Fed is taking a cautious approach. The Syrian crisis also caused volatility in markets in August and September as investors worried that the United States might become embroiled in another Mideast conflict. Rising tensions and the use of chemical weapons against civilian targets led to the Obama administration to consider military intervention in the civil war. Fortunately, a diplomatic solution was reached and Syria has committed to surrendering its stockpile of chemical weapons. Meetings with Syrian officials have begun, and we can hope that military action will be avoided. Fourth quarter challenges. Earnings season is upon us, and we're looking forward to seeing how companies did in the third quarter. It's too soon to get an idea of overall earnings and revenue trends, but we've already seen some earnings surprises from firms that benefited from strong demand. So let's move on and talk about some of the major challenges we see facing markets in the fourth quarter. Government shutdown. The first, obviously, is that the federal government shut down on October the 1st. After weeks of debate, Congress just couldn't get it together and pass a budget for 2014. Since the government's new fiscal year started on October 1st, agencies and services that need to be funded each year were shut down and 800,000 workers were sent home. This is not the first time government agencies have had to close down shop. This is the 18th such shutdown Washington has seen since 1976. Fortunately, this is far from a complete shutdown. Generally speaking, it's business as usual for most essential government functions. Social Security checks will go out, U.S. troops will continue serving, prison guards and Border Patrol will keep working, and the federal hospitals are still staffed. The SEC, which can rely on leftover funds from 2013, will be able to maintain normal operations for at least a few weeks. On the other hand, the shutdown will cause a lot of disruption to what the government considers non-essential services. National parks and museums will be closed. Veterans benefits and unemployment checks could be delayed, and SBA or FHA loan processing may grind to a halt. The IRS will halt taxpayer phone services and the processing of refund checks. In short, it's going to be a big headache for everyone, most especially those who have been thrown out of work or who depend on non-essential services. Thanks, Washington. What does a shutdown mean for the markets? Well, investors shrugged off the issue after the opening bell on October 1st, and Wall Street is betting that the shutdown will be short-lived. Historically, none of the government shutdowns have produced any long-term effects on markets. While the shutdown will have a major impact on the Americans who are directly affected by it, we don't expect to see long-term impact on the markets if Congress is able to resolve the budgetary issue quickly. Debt ceiling. The second big challenge facing markets is the debt ceiling crisis, which will strike in mid-October when the U.S. Treasury reaches its statutory debt limit. Unfortunately, the congressional standoff over the debt ceiling may be even more worse than the budgetary debates and could inflict much greater economic damage if it isn't resolved. The Treasury Department has managed to keep the bills paid through a combination of high tax receipts and what they call extraordinary measures. These measures have run out, and the Treasury Department has notified Congress and the President that it won't be able to pay any more bills beyond mid-October. We want to clarify one thing that may be causing some confusion. Keeping the debt ceiling where it isn't really about controlling the government spending. The debt issued by the Treasury is used to pay the bills that Congress has already voted to authorize. It would be like trying to limit your household spending by refusing to pay a credit card bill for things that you've already bought. The reason that the debt ceiling issue is so much more serious than the government shutdown is that while we pretty much know what to expect from a shutdown, the government has never dealt with the debt ceiling breach before, and there are no official contingency plans. When the country reaches the debt limit, the Treasury will no longer have the legal authority to borrow any more money to close the gap between spending and tax revenue. If Congress won't vote to raise the limit, and the recent budget situation makes it less likely that lawmakers will be willing to work together on this, in our opinion, the President will have three basic options. Option 1, President Obama could decide that the government's legal obligations to spend trump the debt ceiling and just order the Treasury to sell more bonds. This option would probably cause some serious political issues in Washington. Option 2, the President could instruct the Treasury to pay some of the government's bills and ignore the rest. We could call this the triage option. Option 3, the third option, is to go into default and not pay anyone. This is definitely the worst option and would have serious ramifications for global financial markets. A default would mean that the United States would stop making payments on U.S. Treasury bonds that are meant to be one of the safest assets in the financial system because they are backed by the faith and taxation power of the U.S. government. There's also the issue of the U.S.'s sovereign credit rating, which may be affected by a protracted debate or any missed debt payments. 2 years ago, in 2011, during another fiscal standoff between Congress and the White House, Standard & Poor's stripped the United States of its AAA credit rating, and they may certainly do it again. The reason this matters is that the lower the sovereign credit rating is, the more interest the United States has to pay its creditors, making it increasingly expensive to borrow money, which will add to the country's debt problems. Federal Reserve tapering. While Federal Reserve's tapering has gotten lost in the furor over budget talks and the debt ceiling, we still expect a tapering decision to affect markets. How much it affects its investors really depends on how the Fed decides to manage the process. As long as the Fed sticks with a gradual taper, it's unlikely that any markets will be affected too much. Realistically, given how cautious the Fed appears to be, it's likely that they will turn off the money spigot. So they won't turn off the money spigot suddenly. Whether tapering starts in October or December, it's not likely to be a smooth process. More likely, the Fed We'll cut back a little, see how it goes, and then adjust the process. There's no guarantee that the Fed will even taper this year if it doesn't think the economy can handle it. What we do know is that Wall Street tends to get a little nervous around the FOMC meetings, and we can expect more volatility as the analysts try to predict which way the Fed will jump. As we mentioned earlier, we believe that the economy is strong enough to withstand a gradual tapering process, and that a lot of the uncertainty is already priced in by investors. However, markets could react badly to any unexpected surprises. So in conclusion, wow, with all these headwinds facing the market in the next few months, it might look like there's no way for the rally to continue. Well, we don't think that's necessarily the case, and we actually see significant potential for upside in the fourth quarter. Here's why. Long-term economic trends are still positive. Hiring is improving. Business spending continues to grow, and economists estimate third quarter and fourth quarter GDP growth at 2.2% and 2.3% respectively. The housing market also remains a major contributor to economic growth, even while rising inflation rates. The global economy is improving. Trends in China and Europe suggest that our largest trading partners are pulling out of their doldrums, and we can hope that global demand for U.S. goods to pick up. We can also hope that the third quarter earnings season provides us with some positive surprises. It's impossible to predict which way markets will move with any certainty, and we always recommend focusing on long-term financial objectives instead of short-term market movements. It's probably no surprise that we can expect more volatility in the fourth quarter. However, one of the benefits of volatility is that it often presents opportunities for flexible investors, and we focus on finding and exploiting those opportunities for our clients. Thank you everyone for joining me today. We appreciate your time and hope you've enjoyed our discussion of some of the important economic issues facing markets this year. If you have any questions about the information I presented, please call me, Howard Reitzel, at 812-323-9200, extension 7571. Or email me at howard.reitzel@investfinancial.com. As always, it's our pleasure to be of service to you and your family. With that, thank you and have a great day.